All right, listen, something major is happening before the US even really wakes up. Silver is up about 3.7% in the last 24 hours, trading right around $80.58. And if you're thinking, okay, that sounds bullish, yes, but the timing is the story. This move is showing up before the US cash session is even fully underway. Now gold is also up, but nowhere close to silver's pace. Gold is sitting around $5,006, up roughly 0.8%. So you've got silver sprinting, gold jogging. And whenever that happens, it's telling you one thing. The market is doing more than reacting. It's repositioning. Because silver doesn't move like this casually. Silver moves like this when something changes under the surface: liquidity, leverage, policy expectations, or a sudden scramble for exposure. And here's the part most people miss. When silver leads this hard, it often means one of two things is coming next. Either the move was real and the rally extends, or it was a pressure release spike, short covering, thin liquidity, weekend gaps, and the next US session becomes the real test. So in this video, I'm going to walk you through the three things that can create this exact setup, why the timing matters so much heading into the US Open, and what levels and signals I'm watching next, without hype, without charts, and without guessing, because the next 48 hours can turn this into the start of a bigger leg, or the cleanest bull trap you've seen in months. What you're seeing isn't the mainstream explanation. Let me show you the three things happening right now. First, this is a timing event, not just a price event. People love to talk about silver is up, but the when matters almost as much as the how much. A lot of the biggest directional moves in metals start before the average investor is paying attention: overnight sessions, thin liquidity windows, and pre-open repositioning. And that matters because it changes the type of buying you're seeing. When silver is moving hard before the US day session, it's usually not the slow, steady accumulation crowd. It's usually traders. It's usually leverage. It's usually positioning. And when positioning flips quickly, it can overshoot in either direction. Second, the divergence between silver and gold is flashing a signal. Gold being up around 0.8% is strong, sure. But silver being up 3.7% is a different animal. Silver has an industrial identity and a monetary identity, and when it accelerates faster than gold, the market is often pricing in one of these narratives. Either growth expectations are shifting, or inflation expectations are reheating, or the market is hunting for high beta exposure to the same macro story that gold represents. Silver is basically gold with a turbocharger and worse suspension. When things are stable, that turbo doesn't matter. When things get unstable, it matters a lot. Third, the macro backdrop is still feeding metals, even when the headlines look quiet. I know people want a single breaking news trigger they can point at, but markets don't always give you that clean storyline. Sometimes metals move because of an accumulation of pressure: policy uncertainty, currency moves, central bank behavior, and the constant question in the background: are we heading into a regime where real assets matter more than paper promises? And you can see that question showing up in one place that doesn't care about narratives: central banks. China's central bank has been adding gold again, continuing a buying streak that's now been going on for over a year. And that matters because central banks don't chase memes. They don't FOMO into weekly candles. They buy for one reason: to change the composition of their reserves for the world they think is coming next. So when you line these three together, pre-open silver strength, a silver over gold sprint, and official sector demand staying firm, you get a setup where Monday's US session becomes a decision point. Not a prediction point, a decision point. Now here's what Wall Street analysts aren't discussing. The institutional behavior comes first, and then the headlines get written after. Smart money moved before the crowd noticed. Let's start with the most grounded signal we have: central bank behavior. When a major central bank is consistently adding gold, it's not because they think they can flip it for a quick profit. It's because they're preparing for currency risk, geopolitical risk, and a world where settlement and reserves become more political. And even if you don't care about geopolitics, this matters for one simple reason: it creates a sticky bid under gold, a bid that doesn't disappear because the price dips one day, a bid that keeps showing up month after month. Now, why does that matter for today's silver move? Because silver often reacts like a leveraged version of the precious metals complex when the market senses that the monetary story is back in play. If big players believe the long-term bid for gold is real, they sometimes express that view through silver because it can move more, faster. It's higher volatility, so it attracts momentum capital. But here's the interesting part. That momentum capital isn't loyal. If it senses the move is stalling, it leaves just as quickly, and that's why the timing into the US session matters so much. Because the US Open is when liquidity deepens, spreads tighten, and the market decides whether the move is strong enough to survive contact with real volume. Now layer in the Fed backdrop. At the last major Fed decision, the committee held rates steady in a 3.5 to 3.75 range. But there were dissenters, people who wanted a cut. That tells you something important. Even inside the Fed, there's not a perfectly unified story about what comes next. And when the market senses that uncertainty, metals can catch a bid, because metals tend to like two things: falling real yields and policy confusion. Now, I'm not saying rates are about to collapse tomorrow. I'm saying uncertainty creates optionality, and gold loves optionality. Silver loves it even more because it exaggerates it. So if the market is sniffing out a future where cuts become more plausible, or where inflation reaccelerates enough to make the Fed's path messy, you often see silver pop first and hardest. That's what makes this move dangerous and exciting at the same time, because it can be the beginning of the next leg. Or it can be a positioning spike that fades once the US session forces everyone to show their hand. So I analyzed the chart this morning, and here's what jumped out at me. And I'll keep this simple and practical. We're sitting around $80.58 in silver right now after a strong 24-hour surge. When you get a move like that, you have to think in terms of levels that traders anchor to, not because charts are magic, but because traders are human. They remember round numbers. They remember places where price stalled or reversed. They remember pain. $80 is one of those psychological lines. Even if you've never traded a day in your life, you feel it. 79 feels like still under 80. 81 feels like we broke it. So the key question into the US day is not, is silver up? The key question is, can silver hold the 80 handle when the real volume comes in? If it holds, the market sends a signal. This wasn't just a thin session spike. If it fails, the market sends a different signal. The move was fragile, and late buyers could get trapped. Now here's where people get wrecked. They see plus 3.7% and assume continuation. But high volatility assets don't reward assumptions. They reward process. So what's the process? 1. Watch whether silver can stay above that round number zone through the US morning. If it can, the move is more likely to be accepted by the market. 2. If silver dips under 80 and snaps back quickly, that's often a sign of buyers defending the level, almost like a stress test. But if it slips under and starts living below, the psychology changes fast, because then every buyer from the breakout starts thinking, do I cut this? And when enough people think that, at the same time, you get a quick air pocket. And remember, silver is leveraged emotion. It doesn't drift down politely. It drops fast when the bid disappears. Now, the 50-day moving average, just to explain what that is, it's basically the average price over the last 10 trading weeks. Traders watch it as a trend line to decide whether the market is in a sustained uptrend or just a temporary spike. I'm not going to throw a number at you that I can't verify in this moment without visuals, but I will say this. When price is stretched far above those medium-term averages, the market often tries to mean revert, meaning it tries to cool off, shake people out, and then decide what's real. So the move we're seeing right now is powerful, but it's also the kind of move that invites a shakeout. That doesn't make it bearish, it makes it honest. Now let's talk about the fundamentals, the real supply and demand picture, because silver is not just a money metal, it's a material. It gets used up, and that single fact changes everything versus something like a tech stock where supply can expand overnight. When silver demand rises in the real economy, manufacturing, electronics, energy systems, that demand tends to be sticky. Companies don't stop making components because the price of silver rose a few bucks. They might hedge, they might optimize, but the usage is real. Now, on the supply side, silver has a structural issue people underestimate. A large portion of silver supply doesn't come from primary silver mines. It comes as a byproduct of other mining like copper, lead, and zinc. Here's why that matters. If the economy slows and base metals activity slows, silver supply can get squeezed even if silver demand doesn't collapse. That's a weird dynamic. The thing that produces silver isn't always driven by silver's price. So if you're watching silver like it's just a trading ticker, you miss that it can tighten at exactly the wrong time. And that's why silver can go from sleepy to violent so quickly. Now gold is different. Gold demand is more financial and monetary. Gold is more about reserves, protection, and policy expectations. So when you see gold up modestly and silver up aggressively, it can mean the market is pricing both stories at once. The monetary hedge is alive. And the industrial optimism, or the speculation on that optimism, is showing up in silver. But fundamentals don't tell you what happens tomorrow morning. They tell you what happens when the dust settles. And if this is the kind of environment where central banks keep accumulating gold and the market keeps worrying about the credibility of currencies, that creates a long-term tailwind. Silver just expresses that tailwind in a much more dramatic way. Now, we've seen this exact pattern before, and I want to take you back to a period that explains silver psychology better than any textbook, early 2020. Because 2020 wasn't just a pandemic year, it was a stress test for liquidity. Here's how that sequence worked in plain English. First, fear hit. Everything sold off. People sold what they could, not what they wanted to. Metals got hit too, even though they're supposed to be safe havens, because in a liquidity crunch, the first goal is raising cash. Then the policy response arrived. Massive stimulus, rate cuts, emergency measures, and that's when metals flipped. Gold moved first, but silver did what silver always does in those moments. It lagged, and then it launched. And when it launched, it didn't move like a calm investment. It moved like a spring that had been compressed for months. Now what's similar today? We're not in the exact same crisis, but the pattern of psychology can rhyme. When policy uncertainty increases and official sector demand stays firm, gold becomes a baseline. Then silver becomes the expression trade. It becomes the way traders try to amplify the thesis. And the same exact thing happened in 2020. Silver's moves became larger and faster than gold's. But here's what everyone forgets about that era. The path was not straight. There were savage pullbacks. There were shakeouts that made it feel over, and then it wasn't over. So when I look at silver up 3.7% into the US Open, I'm not thinking, this is guaranteed. I'm thinking, this is a setup. And the setup is about whether the next wave of liquidity confirms it. Because in 2020, the biggest mistake people made was assuming the move would be clean and friendly. Silver is not friendly when it's moving. It's fast, it's emotional. And it punishes anyone who confuses a thesis with a time frame. So the takeaway from that historical parallel is simple. If this is the start of a new leg higher, you should expect volatility. And if this is a head fake, it will reveal itself quickly once US participation ramps up. Let's make this personal. Because you're not watching this to win trivia night. You're watching this because it affects your money. Here's what a lot of people do with metals without realizing it. They treat gold like insurance, and they treat silver like a trade. But then when silver moves, they emotionally upgrade it into a long-term conviction right at the top of a spike. That's how people get hurt. So let me translate this move into real dollars. If you own 1,000 ounces of silver, whether that's physical, an account, or exposure through a product, silver moving 3.7% is not a headline. That's a change in value of roughly $3,000 in about a day. Now scale that to someone with 10,000 ounces, which is not crazy in this community. That's roughly $30,000. That's why people get emotional. Now compare that to gold. If you own, say, 10 ounces of gold, and gold is up around 0.8%, that's still meaningful, but it's calmer. Gold is the slow heartbeat. Silver is the adrenaline spike. Now here's the danger zone heading into the US session. If you chase silver because it's moving, and then it mean reverts, you feel whiplash. And whiplash makes people do dumb things. Sell at the wrong moment, buy back higher, repeat. So what does a smarter mindset look like? It looks like asking, what does this move change? Not, how do I react emotionally? This move changes one key thing, attention. Silver just put itself back on the front page, whether financial media admits it or not. And when silver captures attention, liquidity follows, volatility follows, options activity follows. That can create opportunity, but it also creates traps. Now, the people who handle this best are the ones who already have a plan. Not a prediction, a plan. They know what price zones they care about. They know what would make them add exposure or reduce exposure. They know what they're watching in the macro, and they don't let a single overnight spike rewrite their entire identity as an investor. I've been tracking this market for a long time, and I can tell you the truth. Most people don't lose money because their thesis was wrong. They lose money because their timing was emotional. So if you're watching silver at $80 and change, the smartest thing you can do right now is treat this as a live stress test. Can it hold this level when the US session comes in? Can gold stay firm alongside it? Can the market absorb the move without snapping back violently? Those answers matter more than anyone's hot take. Look, the question isn't whether we see more volatility. The math is clear. When silver is moving this hard into a major liquidity window, the next session decides whether it was real demand or temporary positioning. The real question is, are you positioned for what comes next? In every previous cycle where policy uncertainty rises and trust in paper promises gets questioned, tangible assets tend to matter more. Right now, silver sits around $80.58. Gold sits around $5,006. And the next week, honestly, even the next couple of sessions, will tell us whether this was a breakout that gets accepted or a spike that gets faded. If we hold key levels through the US morning, that's one story. If we fail and slip back under the big psychological numbers, that's another story. I share real-time updates and deeper analysis on social media. For those wanting exclusive research, members-only analysis, or early warnings, there's a premium level. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations. But the data tells the story. All right, before you go, 3 quick things. 1. Drop a comment below. Tell me where you're watching from, and give me your prediction. Where do you think silver is headed by the end of this week? 2. If you're not subscribed, hit that button now. I'm putting out unfiltered analysis consistently. And listen, I'm fighting copycat channels stealing this content. If this video provided value, comment "data over hype" so the algorithm knows you're here for the original. 3. Next video drops tomorrow. And I'm covering the one data point that just triggered. Because last time this flashed, metals didn't move slowly. It moved fast. You won't want to miss it. See you there.